Good afternoon and welcome once again to Digital Look TV. With us today is Simona Gambarini. She is research analyst at ETF Securities. Simona, thank you very much for joining us.
Thank you.
Okay, investors at the moment are being attacked by a multitude of risks on all fronts.
Yeah.
Some of these have to do with the commodity space, but independently of this, the commodity space is often seen as an institutional reserve.
Yeah.
A lot of investors don't know the benefits of investing in this asset class. So perhaps we can go or run through some of these, if you're okay with that?
Yeah.
Okay,
Sure.
Let's start with oil. This is probably one of the risk factors now. There are several factors which are affecting the price. One of these, Syria.
Yes.
Another, a very tight underlying situation as far as fundamentals go. What is your outlook for the oil price? What do you think are the factors which might affect it? What's your view?
Well, oil prices have been rising quite a lot on the back of the Syria situation.
Certainly.
The thing is, Syria is not a strategic player in the oil market. It's not positioned in a way such that it can control actually oil supply or just oil passage. So that's really important to bear in mind, that oil prices have been rising only on expectation of possible contagion or on a worsening of the situation in Syria. Because if the situation in Syria starts moving around and spreading around into other Middle Eastern countries, then that could potentially impact oil prices quite a lot. And on the back of that, we have the Libyan situation and the Nigerian situation. So it's not only Syria that has been driving prices up. So Libya is a much bigger player in the oil market. It's much more strategic. And therefore that could actually have a big impact on the price, as it did a couple of years ago with the Arab Spring.
Okay. At the moment, there's about 3 million barrels a day of oil production offline. Nigeria, Libya, a little bit Syria. In Egypt, there might be some risks as far as political stability, Suez Canal, etc. However, those are certainly negative factors. The underlying situation is tight or excess supply. I believe before you were telling me this?
Yeah, it used to be a little bit of excess supply due to the fact that demand is still subdued because we are still recovering from a global recession.
Yes.
So demand wasn't as high as it used to be before the credit crunch.
Okay.
So obviously we are in a situation of that type. We are not in a situation of tightness at the moment, and prices haven't reacted on the back of potential tightness. They have reacted on the potential implications that the Syrian situation could have on other countries, and that could tighten supply quite more substantially.
Okay. The possibility that the U.S. might tap the SPR, does that exist?
Well, there are rumors that that could happen if oil prices rise above $120 per barrel. So we are still not there. But there are rumors of a possible intervention of the U.S. to ease the situation in the oil market, even because they are behind the Syrian situation, so they want to intervene. So obviously, it's what the market wants is actually lower prices. Okay.
Let's move on to another asset class, or rather another commodity, precious metals.
Yeah.
Gold, perhaps the great diversifier. You'll tell me.
Yeah.
Just today, we've seen on Thursday, long-term interest rates in the United States and the United Kingdom have approached or actually cracked the 3% level. Germany, 2%. Tighter monetary conditions. Gold, have we seen the best in the gold price or not? Also, from a diversification point of view, what's your opinion?
Well, the situation is that of an improvement in the economic conditions across the globe, but in particular in the US. And the US is traditionally the country that drives the gold price quite substantially compared to other countries. So monetary decisions on behalf of the US, then those will drive the gold price quite substantially.
I see.
But we are in a situation in which we've been talking about tapering and the Fed somehow withdrawing some of the stimulus for a long time. And we have also been in a situation in which this tapering is supposed to happen in September or by the end of the year. So those are all spoken things that are probably already reflected in the gold price. So we have to kind of pay attention to how much of this tapering is already priced in the prices and how much is not. So that will give us the potential downfall in the gold price in the future on the basis of just withdrawal of monetary stimulus. So definitely higher interest rates are the reflection of better condition of the economy and somehow have driven the gold price down through time. But we also have to bear in mind that there are strikes in South Africa.
Right.
So gold miners in South Africa are striking, and although South Africa only accounts for 6% of global supply, mine supply, it's still something that could trigger, like some perceived riskiness in the market.
Okay.
And we are also in a situation in which the gold market appears to be a bit tighter than normal. So
how come?
Well, we've seen COMEX inventories falling, and we've seen gopher rates turning negative,
Right.
although they've turned positive in the past few days. And those are all symptoms of kind of some tightness in the physical market. And this could be driven by the fact that all the funds that have been kind of withdrawn from ETFs and moved from west to east. So there has been a lot of demand generated from China and also from India, but mostly from China.
I see.
And that could have driven some of the tightness in the lease market, in the physical lease market. So we are in a situation of that kind, and that is driven the gold price back around 1400.
Okay.
So we need to bear in mind those things. How much tapering has already been priced in? The fact that there is some riskiness, global riskiness, so Syrian situation,
Indeed.
and also more specific risks concerning the industry, like the South African strikes. So there are some factors of concern that could still sustain the gold price around those levels and a little bit above those levels.
I see. Okay.
And in terms of diversifier, as you told me before, gold is a very good diversifier in a portfolio. It tends to be very low correlated with other asset classes like bond and equities and also other commodities, and therefore it provides a good diversification benefits in the portfolio because of those characteristics. It's a defensive asset, so it offers some kind of protection and insurance.
Yes.
But as we all know, we tend to invest in insurance and to get insured before we actually have an issue. So gold could apply to the same logic. Just get some gold so you can actually protect yourself against possible extreme events that were unpredictable.
A good idea to always, for investors, always to have a small part of their portfolio
in gold,
assigned to gold?
Yeah, that is proven to be a good diversifier in that sense.
Industrial metals, very much linked to China.
Yeah.
Some people recently were very pessimistic on China. Now I know that some fund managers are actually stressing quite the opposite. As the U.S. economy heals, China will benefit from this. How do you see the outlook for industrial metals? Do you see a particular situation which might be of particular interest for investors within the space?
Well, industrial metals are cyclical assets. So the US and China tend to be the biggest consumer of industrial metals, and obviously the recovery in those economies is fundamental for the recovery in the industrial metal space.
Okay.
So that it's one thing to bear in mind for investors. In terms of the Chinese economy, we've always been positive. We didn't believe in the hard landing theory and in the slowdown in the Chinese economy. We believe China is slowing down because, as the government says, they are moving towards a internal demand-driven kind of model. So that implies a more sustainable growth level, and that cannot be achieved by double-digit growth percentages.
Okay.
That is not possible. It's not feasible in the long run.
You were also mentioning to me before the interview the importance of focusing or keeping an eye on inventory levels.
Yeah. Because every commodity is a little bit different, and industrial metals, we can talk about the general industrial metal space, and we talk about indexes and diversified baskets of industrial metals, and that obviously is good for investors because it provides diversification.
Yes.
At the same time, when we talk about the single industrial metals, those have very different characteristics. So different supply and demand drivers, different inventory levels.
Okay.
We are coming from a recession, a global recession that brought to an accumulation of inventories. So we stand to very high inventory levels for most industrial metals.
Right. Okay.
So those need to be absorbed before we can actually have a big impact on prices caused by an increase in demand. So this is one thing we need to consider. One way to monitor is to check the inventories and at the same time checking imports from for example, China, which is the biggest consumer of most industrial metals. In that case, we kind of have a grip on what's the sentiment in the market and what's the situation in China.
At the moment, I believe you were telling me before, Chinese demand or import demand for industrial metals is rising, but inventory levels are already high. So that might say something about the underlying real demand in China?
Yeah, and China has been trying to push growth through a series of infrastructure projects and by growing internally. And that is going to generate extra demand for industrial metals. So it appears that they are pursuing that strategy, and in doing so, they will require more industrial metals.
Okay. One thing that frankly fascinated me, agricultural commodities. I think I've always heard of agricultural commodities as something very, very institutional. However, you tell me that it's actually feasible for retail investors to invest through ETFs in the space. And like gold, they have a very, very low correlation, or a low correlation, correct me if I'm wrong, with other asset classes.
They tend to be counter-cyclical, so they tend to be not as much affected by the business cycle because we all have to eat even when there is a crisis, and therefore a certain level of demand is sustaining demand, and therefore that is going to be unaffected by the business cycle. So it's a good diversifier in that sense.
Okay. However, in the very short term, if somebody is tempted to speculate, they can be perhaps a little bit dangerous because of the weather.
As I said, it's a very good diversifier, but to invest in a single commodity, then obviously you need to look at the fundamentals. And the reality of the agriculture business is that it's very much affected by the weather. So demand is quite steady. It can obviously influence prices, but up to a certain extent. What really drives prices to multi-year highs or multi-year lows is actually the weather. And that is something to consider, something that makes those commodities quite volatile in that sense. Like the prices can change quite suddenly due to the change in climate.
Okay, but at least it does provide you a little bit of independence from central banks and the economic cycle.
Definitely. It's not influenced by those factors.
Extremely interesting.
Yeah.
Simona Gambarini, research analyst from ETF Securities. Thank you very much for your time. We do appreciate it.
Thank you.
And we hope you'll join us again soon.
I will.
Thank you very much.
Bye.
And from all of us here at Digital Look TV, that's all for today. We wish our viewers a very pleasant weekend. Thank you very much for joining us.